So you'll often hear us talking about the wider hedge fund toolkit. And one of the tools in that toolkit is something we call short selling. But what is short selling? So very simply, really, it is us selling something we don't own with the intention of buying it back at a later stage at a lower price. And how do we do that? So what happens is we go and borrow a share from a broker. And we then sell that share in the market, wait for the price to hopefully fall, buy that share back at the lower price, and retain the profits, returning the shares to the broker. Now, I'm sure you've got a couple of questions, like why would the broker lend us the shares in the first place? So the answer is that we pay a small fee away to our brokers or whoever we're borrowing the shares from, and they do that on a very regular basis to many, many managers around the country, and it allows for good script movement throughout the industry. So it's a very easy thing for us to do. Another question I'm sure you're going to ask is, what happens if the share price goes up? It's a very good question, and I think this is one of the big parts of short selling that as a manager you have to be very careful about, is to say, if the share price goes up, what happens to my investment? And the answer is you will obviously lose money on that investment. So like if you were to purchase a share and the share price then falls, you would end up losing money on that investment. The same can be said for a short position that moves against you in the right direction. And so it's very important as a hedge fund manager who can use this wider toolkit to make sure that you are sizing these positions appropriately in the overall portfolio so that they're not introducing a risk to investors that you don't want to have in there.